We're continuing down our home buyer series, preparing you to buy your house. Today, we're going to dive into our closing costs as we continue through this process. At the end, I'm going to share some valuable videos with you. The one to help you create a stress-free mortgage process, and a bonus video that will be very valuable to you as well. This is all about being prepared financially and mentally so that you can plan and budget to buy a house. We're going to talk first about upfront costs and then the costs after closing, which would be ongoing. Hey, Ray Williams, Mortgage Maestro Group. And if you find this video valuable as we go through the process, make sure to subscribe and comment below along the way of questions that you have or learns you have had from buying houses in the past. First thing, those upfront costs. Earnest money. If you haven't bought a house before, what the F is earnest money? Well, it's your deposit into the transaction so that the seller knows you are serious about buying the home. It does reduce what you bring to closing. So if you were going to bring $50,000 to closing and you had $5,000 earnest money, $45,000 would be what you bring to closing because that is for a credit for you. Home inspection is something you'll pay for up front. Health and safety on the house. Third, the appraisal. You'll pay at the time that order is placed by the lender for your appraisal if it's required on the home. Think about just separating home inspection, health and safety, appraisal, valuation. They serve two very different important features. Both have costs you want to prepare for upfront when buying a house. Then you got after closing, ongoing from one-time moving costs, possible utility setup. So check in your local area, check with your realtor in the contract about utility transfer. If you buy something with an HOA, ongoing homeowners association due fees, is it going to be monthly? Is it quarterly? Or is it just an annual fee? Then home maintenance. Whatever you buy will have some form of home maintenance. Plan to have 3 to 6 months of rainy day money. Should do that even without owning a house, but make sure when you own a house, if the furnace goes out, you do have money and it's not a sudden emergency, because right now credit card rates are high. If you finance that on a credit card, it's going to cost you a lot of money. So have some money set aside for home maintenance as well. Down payment funds are going to be the money that will deduct from the home price and the loan amount. So it is equity. So there's a misconception about this, because if I put $50,000 down and I used my savings account, in a sense, I'm reallocating the money into an asset, which is the home, over time. So it is commonly overlooked that there is value when you put it down. It will also reduce the payment. How little, how much? That's really a recipe. Think about the perfect recipe, the perfect cocktail. You don't want to have a gut ache or a hangover. So work with your lender so that you can make sure you have the right down payment and achieve the right loan program to meet your budget for buying the house, taking consideration how to determine how much, your future financial goals, your disciplines to save money, meaning after closing, will you still be able to save money to recuperate if that came from a 401k loan, from your emergency fund? What are your disciplines to save money? And after closing, do you really need to have all things new? That couch, that car? Slow and steady, folks. Rome wasn't built in a day. Plan accordingly. With rising credit card rates, it can make that couch really expensive if you don't pay for it in cash after closing. Get your dollars right. Save for you first. The power of compounding cannot be replaced by time. That if you've never read or heard about a book about the psychology of money, I would highly recommend that read. That is a page turner, and that brings a lot of value. Make sure you have your emergency fund. If you've got children or are going to have children, your 529s. What are your plans? Do they involve real estate investing? So think about that when thinking about your down payment as far as that as well. Now let's talk P.M.I. Private mortgage insurance may or may not apply. Depending on your loan type and your down payment, there may or may not be mortgage insurance in the monthly payment. For FHA, it exists. For USDA, there is a form of mortgage insurance. And for VA, there's not, but in all three of those instances, there's also a one-time financed form of mortgage insurance for each loan type that's added to your loan amount. And the trade-off is they allow you to put less money down. USDA can be 100% financing. VA can be 100% financing with no monthly mortgage insurance. and FHA standard down payments at 3.5%, that upfront goes into the master pool in case folks do go into default and foreclose, that those agencies can reimburse the lenders for the lost money due to foreclosure. It's a trade-off for allowing us to put less money down. As a veteran myself, if I do 100% financing with no monthly mortgage insurance, am I okay paying the VA funding fee for these interest rates I would get on a VA loan? Yes, 100% yes. If you have a 10% disability as a veteran, you'll be exempt and will not have the funding fee. So a little bit about the differences. For conventional loans, do know this. Monthly mortgage insurance varies by credit score, by debt ratios, by loan program. If you're a first-time buyer, the mortgage insurance can be cheaper, and there's a whole matrix called loan level pricing adjuster. So talk to your lender. Now let's talk closing costs. And so what you're going to see here is I'm going to paste over a loan estimate. But what are you looking out for on a loan estimate as a consumer buying a home? Whether the rate is locked or not locked, the loan amount, the type of loan. From there, please understand the cash at closing is there as well. From there are lender fees, there are third-party fees, there are prepaid items. Let me break these down for you. The lender fees are going to be things like underwriting, processing fees, cost of doing business. As a broker, for me, there are pass-through fee, pure price, pure cost for you as a homeowner, but ask your lender about your specific situation. Third-party fees are going to be things like your credit reports, your appraisal. The beautiful thing for you as a buyer is you're protected. You're only going to pay the invoice. And if a lender underquotes the appraisal or the credit report, and they say the credit report is going to cost you $60 and it costs them $100, they're going to eat the $40 because you are protected as a consumer. And then title and attorney fees as well. Prepaid items, you have your first year of insurance. You have escrow set up for future payments of taxes and insurance. Pro tip, if you're buying new construction, you may want to waive the escrows in your monthly payment, and here is why. Because when you first close on that new construction home, it's still assessed off dirt. Dirt is cheaper than the beautiful house they're building, and the county has not recognized that home is there yet. So for a year or two, there might be a lag in actual property taxes. If there becomes an escrow shortage, the lender is going to overcompensate and increase your payment. But if you pay the taxes and insurance outside of the payment, you will only ever pay what is owed. And so for the first couple of years, you might pay a lot less in total payments because the taxes are off dirt still. If your escrows are in your payment or they are not in your payment, please understand this. Insurance goes up, taxes go up. I saw my taxes go up 20%. That's going to be a hit on the mortgage payment. That's why when those things come in the mail, pay attention to them, but they can and they will change. Your lender does not control this. But if you have a fixed rate mortgage, the principal and interest cannot change on you. If you have a conventional mortgage, the mortgage insurance can be removed without a refinance. Like I said before, the earnest money, again, remember, it reduces what you bring to closing. So think of it as a deposit. If you cancel because of something within the contract, as long as your dates and deadlines are met, you will get the earnest money refunded to you. But again, have your agent educate you about the real estate contract. It is shocking to me how many people don't even know what earnest money means when they come to me as a lender and they don't know they write a contract with an appraisal gap. They don't know that what that means is if you were going to bring $40,000 to closing and you write an appraisal gap in your contract of $10,000, meaning if it appraises 10,000 under, you'll cover it. They don't know and aren't explained. That means they could have to bring up to $50,000 to closing. So get educated by your agent about appraisal gap if that comes into your conversation. As I mentioned, sharing a few videos for you, stress-free mortgage, and then also that bonus video for you as well. I really hope you find this information valuable and useful. Feel free to save this video to review it again because this is an in-depth dive into what the F are closing costs when you buy a house from Upfront and ongoing. We'll look forward to catching up with you on the next installment of the Home Buyer series. Talk to you soon.